Hi, everyone. I'm Ivan Biuki, and welcome back to Wall Street Silver. Our guest today has called for 10,000 gold in the past. He is the legend himself, Dan Oliver, founder of Mermican Capital. Dan, it's great to see you again.
Great to have me on again. Thanks.
Yeah, it's an absolute pleasure. Bernanke in the past, Dan, he said that the US has this great technology called the printing press. Do you think this helicopter money will ultimately collapse the system?
Well, of course it will. I mean, it's always has throughout history, and part of what my work is looking at places like ancient Rome and the Middle Ages and France of the 19th century and United States, the continental currency. Right now, the continental people forget, but the Revolutionary War was during a hyperinflation. We printed money to fight the war. In fact, there's a great quote from a congressman who said, "Why would I tax my constituents when I can just print the money instead?" Civil War, of course, we had hyperinflation in the South. So this is not a new phenomenon. I mean, hyperinflation sounds ridiculous and scary. And to be fair, most places don't get to the kind of Weimar Zimbabwe stage. I mean, for example, in the 1920s, France's currency went down about 90%. And the reason it didn't go further, because I looked across the border of Germany, I said, we don't want that. And it formed a political compromise between the guys who want to spend the money and the guys who didn't want to raise the taxes, and the compromise and avoided that outcome. And the U.S. and the same thing in the 70s, right? I mean, a lot of commentators thought we were heading down that Weimar path, and we may have been heading down the path, but we got off the path again with about a 90% decline of the dollar. So again, you can have these money printing episodes that get pretty bad and pretty depressing for the country without going down to the going full Zimbabwe.
Mm-hmm. You know, Willem Middelkoop, I just saw him speaking recently, and he said, you know, we shouldn't be using the word hyperinflation because that's really extreme, but he thought coining the term superinflation would be more appropriate. Something, you know, 10%, 25% is probably more likely for now, unless something gets really out of whack, right?
Mm-hmm.
Yeah, I think so. I mean, I have a hard time believing that the U.S. is going to actually hyperinflate. Right? Hyperinflation is a process, and it's a process whereby the central bank is forced by treasury bonds. Okay, we already have that's happening, right? And then you get into a situation where the market says we don't want any of these things, and they throw them all on the central bank. And the central bank has to buy not only all the bonds in circulation, because no one else wants them, but also the government says, hey, we're not going to cut the deficits. We're going to actually expand them because as the money sinks, we have more and more things we want to spend money on for social transfer payments. And then they make the central bank buy that in an accelerating process. And so, you know, certainly, again, as I said, we're on the road to that. I mean, that all those things are familiar. We just haven't reached the extremes that you get at the end of like a real hyperinflation. And I have a hard time believing that we will, because I think at some point when the wheels really fall off the bus, and they haven't yet, because we don't have a situation where the Fed is panic buying every treasury bond on issue. That event hasn't occurred yet. But there are other things they can do. I mean, I continue to think that what happened in Cyprus, I forget, was it 2011 or 12, where they just basically said, okay, the banks have these problems. We're just going to take all the deposits of people who have $100,000 or more in the bank. Right. I mean, that's another way
to the bail-in, yeah.
Your balance sheet. Right. And again, that's not a new policy. That has tremendous historical precedent. I mean, in the 19th century, what they used to do, private banks would do it, but they would do it under the aegis of public authorities. They would just say, okay, so private banks, as you probably know, used to issue their own private currency. We're a private bank. I have a gold in my vault. I issue my private currency, and you can show up anytime you want to with your note and demand the gold. And if I don't have it, I get shut down, right? And in fact, in those days, the bankers had personal liabilities. So not only do I get shut down, I lose my house as well. Well, which was a great way to mitigate risk, right? I mean, kept risk under control. But whenever there was something happening, like a nationwide panic or war or something like that, the state would say, okay, you can shut down convertibility without closing the bank, without losing your house. And they would all do it at once. We call it suspension. And so what would happen basically is the banks are saying, hey, we're defaulting, at least temporarily, on our obligation to pay you the debt we owe you when you show up with a note. Now, the opposite wasn't true. You were not the depositor who didn't get his money back, still owed the bank the money he borrowed from the bank. So it was a really great system as a banker. They owe you money, but you don't owe them any more money. But again, it was a way for the state to preserve the bank system. Remember, the reason why the banks have these special legal privileges And the reason why they act as a cartel because of the privileges is because they funded the state. I mean, that was that was always implied ever since the Napoleonic Wars in England, but certainly it was codified in the United States following the Civil War when the banks would press into service to fund the North because nobody else would. Salmon Chase, the Treasury Secretary, tried to float a bond offering in New York, and no one wanted it. And so they regulated the bank system to force the banks to take the Treasury bonds. It worked so well, we still live with that system 150 years later.
Dan, with weaker employment and all these economic figures we are seeing, can the Fed even taper in the face of all this?
Yeah, well, that's the fun question, right? I mean, we have enormous inflation happening, obviously, and of course, as Milton Friedman said, he was right about this, right? Inflation is everywhere a monetary phenomenon. And of course, the Fed doubled its balance sheet, so we get inflation. And one of the things that I always remind people is that Powell gave a speech in April of 2020, right when these programs ran out. And he said, look, there isn't going to be inflation. He said there was no inflation last time in 2008, and there won't be this time. And anyway, it's not a big problem. And the reason he was wrong about that, the reason it was, to me, obvious he was wrong, is because 2008 was a event driven by overcapacity. There was too much credit. The banks blew up, right? All the housing people blew up. And the Fed printed money by adding new reserves to the banks. And the banks took those reserves and created a new credit cycle, which everyone loves, right? Employment and prices go up and tax revenues go up, all that's wonderful. 2020 was very different. The big companies, the big capital-intensive companies were bailed out directly by the Fed, right? Remember, the Fed bought all their bonds, and the little companies went under, right? They had some programs for them, but basically they went under, those programs ran out, they couldn't get workers, and they can't get supplies. And you think about, for example, as I know little companies, a shipping containers, we all know the price went from, I don't know, $2,000 for a shipping container to $24,000. Now that didn't happen to Amazon. And the reason is because big companies have long-term contracts. And so they get to have a very smooth curve. They're behind that cost curve, whereas the little guy is paying the spot price. So for all sorts of reasons, the entire small part of the economy basically disappeared. And then the other aspect of it is that the Fed mostly, or unlike 2008, finance direct payments to people, right? I mean, all those all the people who were thrown out of work, and the federal government said, we will not suffer. We will give them money, right? Well, they got the money, but there's fewer stuff to buy, and so of course inflation had to happen. And as recently as March of this year, the Fed staff economists were still talking about how inflation was running below 2% and how big problem this was because their target's 2%. That was in March. And by June, Powell was saying, oh, no, it's transitory. And then he he said last week, he said, well, people have different definitions of transitory. I love that. Well, it's still transitory. We'll just change the definition, what that means. Yeah. Then we'll be fine. So we have this major inflation problem. Of course, it's because the Fed is printing money. And so now, obviously, the Fed wants to stop printing money. And this is being driven by companies that call up regional Fed governors and say, oh, my goodness, our input costs are going absolutely crazy. You guys got to stop printing. But to your question, which is the right question, is that when you actually look at the consumer, when you look at consumer sentiment towards buying durables and automobiles and houses and all those things, the sentiment is actually falling off a cliff. The Michigan does a sentiment survey every month. And in fact, the decline and where it is lower than where it was in 2008 in December at the bottom of the panic. So people's attitudes towards the economy are now worse than they were in December of 2008. I mean, think about that for a moment, right? And that's the moment last time when the Fed started printing money up the wazoo, right? And we're in the same situation, only worse now. And the Fed is talking about tightening financial conditions. And what will happen to the propensity to buy stuff if all of a sudden interest rates are going up because the Fed's tightening conditions? It's the chatter in the markets is that the Fed is making a terrible policy mistake. They should be printing more money now, not less. And it all comes back to there was a wonderful exchange in the Greenspan Fed, where they were in the exact situation. This is when oil was going $150 a barrel, and the Fed was panicking, and one of the governors said, "Do we tighten now and create the big crash? We were supposed to stabilize. That's not good. Or do we start printing now if we know a crash is coming? But how do we print now when inflation is going up?" So we said, well, you know what? We'll just do nothing because who knows what we should do. and I love that quote. I use it a lot because it shows the absurdity of the idea that a Politburo sitting around can determine money and credit levels better than the market can.
Wow.
It reminds me of the 4 stages of the government making a decision, and they go from, we can't, it's essentially the 4 stages. Oh, it's too late. We can't do anything now, anyways. So I don't know. If
yeah, well, that's right. And so the other thing that people are talking about that I'm looking at is, of course, the yield curve, right? And the idea is that the Fed has an iron fist on the short end of the curve. So that really doesn't give you any information. All it tells you is what Fed policy is. You know what it is because they tell you. So you look further out the curve in the 10 and 20 and 30-year vintages of the Treasury bond. And there they influence it, but it's not as direct. And now the 20 years yielding more than 30 years. The curve is actually inverted. And if you look at that spread, the 20 to 30 year, it's sort of a basic metric of, I wouldn't say free market, but certainly freer than the short of the curve. What's interesting is that spread bottoms when at 2000, bottom of the panic, and it goes shooting higher through as credit, revives, where the credit engine keeps going again. Then what happens? It plunges into 2008, right, during the panic. Great, and then they print all the money, and that spread, the curve steepens dramatically into 2013. Again, that's the credit-driven economy. Well, you look at it since then, it's falling off a cliff. So again, it's telling you we're heading into a crash. That's what the bond market's telling you. It's what the consumer sentiment surveys are telling you. Is all these economic numbers are telling you that. And this is when the Fed says, "Hey, we're going to stop printing the money." We'll see how that works out. And I think it's interesting that the narrative Wall Street has was this is going to crush gold and silver because, again, when the Fed tightens, of course, who wants gold? Rates go up, gold has no yield, and so you're going to sell your gold and buy bonds, right? And instead, it was really the day Powell announced the taper, and then a couple of days later, when the hot CPI numbers came out, that gold really lit a fire under it. And that's to me is a big deal. It's a big sign the market is calling the Fed's BS finally.
So you're referring to, back around here, I think, and we're since up, $80 to $100, down a bit today, but the market really just caught a bid for gold when sort of the taper was announced on November 3rd.
Yeah, and then the hot CPI number. And the reason that really got my antenna up is that for the last 20 years or 30 years, hot CPI numbers have been met with plunging gold prices. Because the thought was, well, gee, if the CPI is hot, the Fed's going to tighten, that's gold negative, so sell your gold today, right? That's how it's been working for the last couple of decades, 3 decades. But in this case, not only did gold go up, but it stayed up. I mean, it's gone up sometimes. The hot CPI numbers goes up for like an hour, and then it plunges. But this has gone up big and stayed up. And again, it's a signal something's different in the market. And I think the gold is saying, again, the Fed's losing control. And also, I think gold and bonds are looking through the tightening cycle. Bonds are saying, hey, yeah, they're going to tighten 2 or 3 times over the next year or so. And they're saying, yeah, and then they're going to have to print money again after that because things are going to really, really bad.
Do you believe them that they'll get there? Do you think they could actually before they tighten, they got to fully complete the taper, right? So do you think they actually get there and then get to a tighten?
I mean, I wouldn't bet on it, put it that way. I mean, the current schedule is they'll taper through June, right, and then they'll start tightening in July. Is what I think what the futures markets are saying. But to your point, things get much uglier before that happens. And also, the other weird thing is that you look at the Fed's cycle. The Fed has its own cycle. It usually prints money before a big election. It just does, right? I mean, these guys are politicians as much as they are economists, probably more so. Yeah. And here we have this midterm coming up. And I mean, I don't think there's ever been a free fall in popularity ratings the way Biden's experienced. And of course, that bleeds over into the Democratic members of Congress. And then the Fed's going to tighten into the election with all these things happening. I mean, it's going to be a real bloodbath.
Everything you just said plays into your $10,000 gold thesis, right? It's you think gold eventually catches a real bid over the next few years, correct?
Yeah. So I always like when that number comes up, to explain where it comes from, even if it's repetitive, because it just sounds so crazy. But basically,
we've had $30,000 gold people on this channel. Trust me, you sound very calm and reasoned at 10,000.
Yeah, I mean, so it just goes back to the idea that I talk about the dollar price of gold and dollars, and that's just how we think. But of course, if we think about it precisely and rigorously, gold is the metric. Gold is the most stable element. It's free market money. That it's the dollar going up and down against gold, not the other way around. And so again, I think of gold in terms of the Fed's balance sheet. If you want to know what a dollar is, you look at the Fed. The definition of a dollar is a unit of liability of the Federal Reserve, right? And they print these things like mad, and they back them with government bonds. So back in the day, central banks, when they first got going, would buy gold. So they'd issue a note against gold in a vault, or they'd buy commercial bills, that is, invoices of 30 days or less. Well, guess what? 30-day invoices on cotton and flour doesn't have a lot of credit risk in it, because people are going to eat the flour unless aliens land and kill everyone. So there's basically no credit risk, and there was no interest rate risk, because 30 days or 90 days give you no risk. These were basically risk-free instruments that credit was being issued against. And I'll even go further, even the 19th century, when governments pretty much pay back their debt, buying a 1-year treasury bond of a solvent country, I think that's not a good thing, but it wasn't all that risky, right? And so the balance sheets, the assets reflected the liabilities, and Keynes is basically the guy who broke that link and said, hey, just buy whatever you want. And so now we see the Federal Reserve buying these 30-year bonds, U.S. bonds yielding, what's the 30-year yielding right now? I mean, it's some absurd number. I don't even know.
Like I read out 2%.
2%. I mean, that's a nominal yield, right? So that's a sharply negative.
So negative 4%.
Well, officially, right?
Probably negative 8% if you believe shadow stats, right?
And so the point is, at some point, the market is going to say to these little notes we carry on our wallets called dollars, and now electronic versions of it in the bank, hey, what backs this thing? Well, okay. The army backs, the police back. You got to pay your taxes, or you go to jail, or you got to pay your debt, or you lose your house. Those are all good reasons to hold those things. But at some point, when that breaks down, when the power of the state breaks down, and it is breaking down, I mean, that's what Afghanistan shows. Is what the rise in the cities on the left shows. Is what all these Second Amendment sanctuary counties are showing us. That federal power is actually ebbing, not rising. And what happens is, when the market reasserts itself, and that there's one lesson of history, is that the market is stronger than the state. The market will say, hey, what is backing the dollar? What is it? And the answer is not very much, right? And so what gold's function is to go to a price to force the Federal Reserve's balance sheet to balance. And I'd like to use the example of 1980, when gold hit $650 an ounce, all the gold in the Fed's balance sheet 100% back the dollar. The market put us back in a gold standard, not the politicians, not the economists. The market did it, right? Well, obviously, since that time, the Fed's balance sheet has expanded, tremendously. And if you go back to the 19th century, you say, what in a free market, what did the market demand that backing to be? It was 1/3. Right. So gold should form 1/3 of a bank's balance sheet. And by the way, that's when the other 2/3 are what I talked about earlier: commercial debt and 1-year treasury bonds of solvent countries. That was 1/3. And that number today is 10,000. So if gold got to 10,000, the Fed's gold would back its liabilities by 1/3. Right. But of course, the Fed's balance sheet is not made up of 30-day commercial invoices and 1-year treasury bonds. It's made up of 30-year treasury bonds and 10-year treasury bonds and all this crap, mortgage-backed securities, all this stuff. So I think 1/3 is a overly conservative number for when markets reassert themselves. So 10,000 is sort of the minimum one would expect in a dollar panic. I think. I hate to say 30,000 because we just said our crazy, but the 30,000 a day would balance the Fed's balance sheet. Now, that's not the equilibrium number. That's not my argument. In 1980, it was 650 for about a minute, right? We'll get to 875 for about a minute, and then it went down, as it should have. That's not a good time to buy gold, but that's how crazy you can get. So it could tag that in just for like a minute in a super duper dollar panic. But as I always say in these interviews, that's looking at the Fed's balance sheet as a static number. Right? When I first gave that number, and it was like 2/3 of the Fed's balance sheet. Now it's 1/3 of the Fed's balance sheet because the balance sheet has doubled since then. So if we assume the balance sheet is going to double again and double again and double again, that number keeps going higher. And so again, and again, I mean, that doesn't mean, going back to our original point, that we're heading down, that we're going to be full Zimbabwe in like 2 or 3 years. But it does mean that you could see like an 80-90% decline in the dollar, which is what happened in the 70s. There's nothing extraordinary about that. Happened to France. No one knows about it, but it happened to France in the 20s. It happens all the time. So I think that is, I mean, the money has already been printed to make that happen. We're just waiting for the right event to cause it to happen. And to the extent they print more money, it'll be worse.
Well, we're Wall Street Silver. So do you look at the gold silver ratio? How do you see silver in terms of your 10,000, 20,000, whatever target it is you think we're going to? What the ratio for silver?
Yeah. So So again, stepping back, silver. I think we talked about this last time, but it's been so long, everyone forgot probably.
Yeah.
So I can repeat myself. But through most of history, gold was used for capital transactions, to ransom your king back to buy a ship. Big transactions. Silver was used for small transactions, right, to buy stuff in the market, whatever it is. And they floated. It wasn't a legislated ratio, and that ratio in antiquity was 10 to 1, and they got to about 15 to 1 by the 19th century. In my view, what demonetized silver properly was when banknotes came out, because then you could have fractional gold of tiny amounts. Like, I mean, you can't go to market to buy eggs with gold because it's really tiny. But if you have a banknote that represents the gold, you don't really need silver anymore. And silver started in the 1870s when banknotes were again issued by solvent countries that adhere to the rule of law. It really meant you didn't really need silver as a monetary metal anymore. And silver really went down a lot. In the Great Depression, it got absolutely crushed because the dollar as a transactional thing was absolutely fine. It was the banks that were the problem. It was capital that was the problem. Gold did well. Silver did not do well. You fast forward to the 70s, right, during the inflationary period, not only were the banks killing ground for capital because of inflation, but the currency was too. And again, I've heard lots of anecdotes from the 70s of cash businesses like taxi cabs and laundromat people who at the end of the day would take their dollars that they revenue and turn it into silver because they didn't want to hold the dollars over any length of period of time. And again, gold, the way it's denominated, if you're a taxi driver, buying bar gold isn't really there. If you're not doing a bar of gold, then your spreads get bigger and it's not very efficient. So you buy silver. And that's what caused silver to do so well in the 70s. And so to answer your question, I think we're heading into a very inflationary environment, which is bad for capital, means good for gold. It's also bad for the transactional value of the dollar, which means that's good for silver because as gold gets more and more valuable, it's just much easier to go buy little bits of silver than it is gold. So I expect silver to outperform gold as this credit bubble that we're in unravels. And not to mention the fact it's not my forte, but certainly silver has an industrial side to it. Now, to me, that can be negative because the whole point of gold is it doesn't have industrial use because it measures industry. As George Gilder says, you don't want your measuring stick to be part of the thing you're measuring. And so that's not so great for silver. On the other hand, the way it is used in the industry, and my numbers could be off a bit, but I understand that a $2,000 Apple laptop has about $10 of silver in it. Well, if that goes to $20, it really doesn't matter to Apple what that costs, but they got to have it. There are no real substitutes. And now I know solar panels do tons of silver. And again, the Chinese they're not green environmental idiots like the UN and we are in the West. They're worried about hydrocarbons because they import oil through Russia, a historic enemy, and the South China Sea, where the US has a navy. And so they're desperately trying to get their own domestic energy supply. So they're super high on coal and solar power. So it may be that as we've seen in other industrial metals recently, that there is a scramble for silver as these big players who use the industry don't want to run out of supply and say, hey, we're going to stockpile 2-3 years of this stuff just to make sure we don't run out because the chip manufacturer runs out of silver, the thing stops, right? So I think it also has that potential to pull a natural gas on the industrial side as well.
That raises a good point with solar. I saw some numbers that 80 million ounces, 1/10 of global mine supply, is currently used by the solar industry, and to get that much silver only gets them to about 2% of our electricity. So you hear numbers like, they want to mandate 40% or whatever, some insane numbers. It's like, we don't make that much silver anymore. It just
that's right. And also, most silver is produced as the byproduct of other mines, not primary. So there are very few primary silver mines. And so what can happen too is, if China, I've always thought China will blow up at some point. It looks like it is blowing up. And China consumes about 1/3 of every commodity you can think of in terms of building those ghost cities that no one lives in. And so if China blows up and you see base metal mines closing, you'll see silver supply going down no matter what silver price is. Silver can go to $100 an ounce, but it's not going to save your zinc mine. So you're still going to close it down. And so you're still going to lose that supply. So it has a weird supply-demand dynamics. And it's because it's such a small market, it really whipsaws in both directions.
We're almost out of time. I know we have a limit here. I wanted to ask you, there's one company that you're involved in as a direct. Your main business is you're the founder of Mermican Capital, but you're also director of a company called Guanajuato Silver, and that is a junior miner in Mexico. What made you buy that one? Why? What? And become a director of it, no less.
James Anderson.
Yeah.
He's the CEO. I knew him from his previous company, New Legacy Gold, which was a challenging assignment. And he came to me when he had a mine. It was an interesting story called El Pinguico in Mexico. This little company was 5 cents a share, been holding it for 9 months. The previous management team was less than stellar, and they reopened it, starting at 3 cents, and I held my nose and bought it. But what I liked about it was, so one of my themes is that gold has constant value through time, and that's what makes such good money. Commodities actually fall over time. People think it goes up because the nominal price goes up. They don't. As technology increases, our use of commodities gets more efficient, and our mining techniques get better. And so if you look at a gold commodity ratio and also a silver commodity ratio, commodities fall against gold. And what that means is that cutoff grades keep falling. So you can go back to a mine that was 100% mined out 100 years ago, and all the stuff they left behind is mineable. Cutoff grades 100 years ago were half an ounce per ton. Today, an underground mine, you can mine 3-4 grams a ton. And so the El Pinguico mine was one of the highest grade mines in Guanajuato, which is played the Spanish for 400 years ago. And when the Mexican Revolution broke out in 1913, they just dropped shovels and ran away. I mean, they left ore in the mine, they left their train car like in the mine, I mean, they just literally ran away. And so it wasn't only that you can go back to an old mine in this case and mine stuff they couldn't mine back then, but the stuff they were mining never got mined. And so that intrigued me. And then we were trying to attempt through that company, we had much smaller ambitions at that point, to toll mill it through one of the neighboring companies, and we got the opportunity to buy the El Cubo mine from Endeavor. And Endeavor had bought it for $200 million 9 years ago. They spent $30 million renovating it, more capex into it, and they couldn't make it work at $50 an ounce silver, partially because the mill was too big for the mine size, and so they just were trading dollars, and they wanted to move on. So they sold it for 15 million, which in my view was a steal. And the difference between us and them is we have got 2 mines. We have the Pinguico and the El Cubo, so we've got 2 mines and running at a 2/3 capacity. So we don't have the problem of chasing low grade ore in the mines. We can be more selective at what we mine, have higher grades and higher recoveries, and get a better cash. And we also have the 1/3 of the mill we're not using, and so there might be opportunities to bolt on other projects or grow slowly into that, so we're not chasing our tail at times.
Dan, thank you very much for joining us. It's always a pleasure. As I like to tell other people, my last video where we had you on, I felt like I was listening to my favorite economic history teacher, and I never wanted the class to end. I mean, that's how I feel listening to you talk, and I think our audience feels the same way based on the comments I saw in the last video. So we look forward to talking to you again in the next few months. We really appreciate it.
Let me know. I'll come back anytime. Thanks.
Right.